We had David on February 18th of last year, 4 days after Valentine's Day, and which of course today is February 14th. Alphabet, that did okay, total return of 18%.
Yeah, so technology has been a theme for us all year, and we continue to own Alphabet. It continues to perform really, really well. Of course, at that time, we were at a period where the biggest names were the things that were working best. We have moved over the course of the year to include now mid and smaller cap securities. So we're not in a world where technology is dominated by the FANG stocks. So I think it continues to be a core holding. But there's lots of other names in the groups now to also participate.
It hasn't got you as excited as it might have a year ago.
Look, it's going to be a great core position in the portfolio, but I love the fact that we've moved from a market that was very narrow, meaning very few stocks were doing well, to a world where many more securities are participating, and you can really differentiate yourself. You know, I mentioned earlier correlations, and I just want to go back to that for a second. At precisely the moment the world has decided that passive, low-fee investing is the way to go.
It's not the way to go anymore.
After 15 years of asset managers being stupid, let's face it, is the moment in time where it's the best opportunity in 15 years to be an active manager, because some stocks are doing very, very well within groups and some stocks are doing very poorly in groups. So it's hard not to look backwards at what has worked. Yeah. You have to be looking forward, and actually this is a great time to be an active manager.
I always get a bit worried by you active managers, though. Are you like guys with a hammer and every problem looks like a nail?
You know, I think that people who know us know we very clearly over time have been, there's a time to play defense, and we get very defensive. We've been as high as 70 or 80% cash at times. And there's a time to play offense. And very often, the time to play defense, it's unpopular to be the guy that's bearish. And in a bull market, it's hard to be the one to continue to be bullish when things look expensive relative to recent past. But the way you make money in a bull market is you stay invested and you stay bullish and you stay focused on the groups that are working. And there's some clear leadership in this market.
People who were putting money to work, for example, March of 2009.
Right, exactly.
Yeah, you could have bought BMO with a 10% yield.
Right, and it was a very unpopular time to put money to work.
General Electric, this one, modest return, 6%, not bad.
Yeah, so industrials have been a theme for us over the course of the year. And we've talked about Ingersoll Rand, we've talked about Eaton Corp, and we've talked about the defense companies like Raytheon and so on. GE was probably the first and most chicken way to put our money to work in industrials. And since then, you know, our portfolios have broadened out quite a lot. About 20% of our equity portfolios are industrials. Which is probably the most under-owned sector of the market, but the one with the most upside as we go out over the next 5 years. If you think there's an improving U.S. economy, a little bit better tax situation, a little bit better business-friendly environment.
Although I noticed critics of Mr. Trump are saying, well, it's all very well saying I'm going to help the factory workers, but it's the ones in food service who get the rotten wages, who get the tough deal.
Well, yeah, and I mean, you know, listen, I think it's a tough time to be an employee. It's a great time to be selling equipment that helps companies be more productive. So as they build plants in the U.S., they're not building a lot of jobs. They're building a lot of, you know, automation and high-tech Internet of Things type equipment.
Sorry, we're running short on time there. I'm yakking too much. Sherwin-Williams, nice pop, 22%, the paint maker.
Yeah, we really like home building and the building industry in general. There's a big pent-up demand, and as people renovate and build new, you know, the paint companies are doing very, very well.
I know you have a renovation stock coming up later. Yeah, new home sales, though, not picking up as quickly as people had hoped in America, although they are recovering.
Well, in most states, new home sales are growing at greater than 10%.
Oh, okay.
And there's about 9 million millennials living in their parents' basements that have failed to launch at this point. And so we are seeing a pickup, and it's the biggest multiplier effect of any industry in the U.S.
I have put my offspring on notice. You get your BA, and then it's out of there.
Right, stop cooking with cheese, right? Isn't that the line?
Why? Because they love cheese?
Because if you keep cooking with cheese, they're going to keep coming home.
Oh, that's right. And they can consume cheese, teenagers. Okay, we're going to be back with David Burrows. He's Chief Investment Strategist at Barometer Capital Management. I'm only cooking with olive oil from now on. The topic, North American large caps, 1-855-326-6266.